In the know with Realtor Roshan, let's unpack mortgage. Hi everyone, my name is Roshan Basnet, real estate broker with Right Arm Realty, and I help you buy and sell in Oakville and Burlington, and I go where my clients take me. Today I have the great privilege of having Ming Wong from Polo Loans here to talk about mortgages. Ming, welcome to the show.
Well, thank you for inviting me, Roshan. I think it's very important that when we sit down and talk about this, the information that we're unpacking, as you said, unpacking, it's important that the customer understands that they have to get approved before they actually go out and look for a house.
Yes, that's the first advice right there. So Ming, tell us, how long have you been in this industry?
Oh, I've been in this industry for a long, long time, and you can tell by the color of my hair. Now, part of that is, I've been in this business for about 25 years. I've been working in the banking industry for at least 20 years. And then from there, I switched over to working on my own business, which is the Polo Loans.
I see. So what is Polo Loans?
Polo Loans is a mortgage brokerage company. We provide home financing for many companies. In fact, not only home financing, we have land financing of commercial deals, but a lot of our mortgages are really residential mortgages that we have. So we come to clients, we work with them on coming up with financing solutions before they actually go look for a house.
Wow. So is that what's called independent brokerage?
Yeah, I think the independent comes back to the fact that we work independently. We don't represent specific lenders. We all work for ourselves. No different than you. You're working for yourself. I know you're represented by a mortgage brokerage company, but You're really an independent real estate agent that you work out yourself. So you're business for self.
Great. So when consumers start working with mortgage professionals, they come across different titles: mortgage specialist, mortgage broker, mortgage agent. What are you?
Yeah, I'm a mortgage broker.
Okay.
That's what it's called. Mortgage brokers are the people that are licensed, that have been, I guess they have to pass the accreditation. So it takes about 2 years before you actually get your mortgage broker license.
Got it.
You can be a mortgage agent when you start. So the difference between a mortgage agent and a mortgage broker is experience. That's number one. Number two is that you have to actually pass a test. There's also mortgage specialists, which when they go to the branch and work with a bank, they're called mortgage specialists, but they sell only one brand.
Oh, I see. So if you're going to an independent bank, one of the 5 banks, let's talk about it, they have a title mortgage specialist. They are really truly just representing the bank. Their interest is the bank.
Yes. Exactly. I can have a portfolio of lenders. I can deal with many lenders, which really, take a look at a broker. You're really a person that works in between the customer and a lender, okay? But we also work with only one company, so our company is Polo Loans. I cannot go to another mortgage brokerage company and work for the other company, which is very, very different. So we have the similar number of lenders, and we have more lenders, and really our service is to provide our clients with solutions, but we represent Polo Loans only.
Okay, I see. So how do you choose, if I come to you for a mortgage, how do you choose where you're going to send my application?
That's a very good question. So usually we have a process in which we go through when we're meeting with clients. So the first thing is we do a pre-qualification.
Okay.
You call me, we meet with you face to face. I'm doing a lot of Zoom now, actually a lot of Zoom now. So we go through the process where we say, okay, how much do you make? What's your down payment? What's your credit like? What's your liabilities? We put all that together and we say, hey, based on the information that you've provided us, this is how much you qualify for. Okay, now that's the step one.
Right.
Okay, because sometimes as we go through those steps, we'll find out that, hey, maybe you have a little bit more options, you can do this, the customer may not have thought about. Or there may be some restrictions because of this, this, and this. And then from there, we will do the next step where we'd say, okay, now to get more accurate information, we'd like you to complete an application, and then we'll take a look at getting the documentations to support what you've told us. And that's a very, very critical piece of the pre-approval.
Great. So you look at all of this information, and then based upon the client's risk profile, you also match it with the lender that would have an appetite for that client?
Definitely. So when we're talking about the type of lenders that we deal with, we have lenders, clients that qualify for what we call bank type lending. So they would have the qualifications to meet their criteria. Then we have clients that only qualify for smaller banks, which are trust companies, and they're basically in the subprime categories. So we'll say you have options, 3 options in this category. You have or and then you can choose from, and we'll take a look at what those options are. Or you can have, in the A category, you may have 6 options as available to you. Then it's up to us to have a discussion to see what you qualify for.
Great. So having options is a good thing.
Definitely.
Right? If I just walk into a bank, I'm just talking to their full-time employee, whereas if I'm talking to you, you have the best interest in mind for me, and you can put my loans together with the right lender. Who is allowed to lend mortgages in Canada?
Who is allowed to lend mortgages in Canada? Well,
that's right.
I mean, so the banks generally, when we talk about banks, generally they're federally regulated. So they can lend anywhere right across Canada. When you talk about credit unions, they're generally provincially regulated.
Oh, I see.
So they can only lend in the province. Some of them will extend beyond that because they have other license. The trust companies are generally regulated provincially, but some of them are allowed to, as long as they license right across Canada.
I see.
The private lenders,
yes.
This is really where, people really need money, and they can't get the banks to lend them money or the trust company to lend them money. We use the private lender, and this is where they could lend anywhere across Canada as long as they have the collateral for that, and they work on that, and they say, we'll lend you the money based on that. So that's what we call private lender, which is a little bit more expensive.
Got it. You're doing a lot before you even put your application to the lender. So how much does these clients have to pay you?
Well, that's the good news for the clients. There's actually no cost for the clients for us to do all this work, right? We'll do all this work in advance to make sure that you qualify for a mortgage, to make sure that all the documentation fits the criteria, because at the end, we get paid when the deal closes. So in most cases, we get paid by the lender, so there's actually no cost to the client. Sometimes, if it's a trust company, things like that, where they collect fees, we may charge a minimal fee associated with that. So
wow.
Sometimes what we have is we actually work with clients where, they may not qualify today, and that's fine. There's many reasons for that. And they may qualify in 6 months, 8 months. So we will work with them for the 6 to 8 months until they get their dream home. That's our job, to make sure that happens.
Wow.
No different than what you do. You're working with the clients until that period of time. So we definitely, obviously have your interest in place, and we definitely obviously want to close the deal.
Yes.
But if there's reasons in which, for whatever reasons, you're not closing it, that's okay, because we're looking for you as a customer for life.
So Ming, if someone wants to come for a mortgage, where do they start?
Well, I guess the quickest way is to start with a quick conversation over the phone. It's very casual. It takes maybe about 15 minutes for us to do it. It could be a phone, it could be Zoom, it could be a meeting if they want to, where we go through the process of pre-qualifying you. It only takes about 15 minutes. And really what we do is we take a look at your income, take a look at your down payment, and we take a look at your liabilities. And we say, based on the information that you've provided us, this is how much you qualify for.
Great. So is that the same as being a pre-approval?
No, that's called a pre-qualification.
Oh, okay.
All we're doing is we're qualifying you for the first time. Then after that, so take a look at pre-approval. So now we're going to ask you to put an online application, so you complete the application for us. We're going to ask you for some documentation so that we can review it. We may be required to pull a credit bureau. That may be the case. Sometimes we don't need to pull a credit bureau, depending on the information. You may be able to pull your credit bureau yourself, send it to us, we can look at it, okay? Now, if you want a pre-approval, okay, which means that a rate guarantee is provided to you, that's when we submit it to a lender and say, oh, now you have a pre-approval for 120 days.
Oh, okay. So before shopping a home, when you hear about get a mortgage pre-approval, that actually means not just a conversation pre-qualification, but in fact, putting together the application, you having a review of that, and then taking to the lender and getting a rate lock.
Yes. So for us, Pull loans, the way we operate is that we actually take the application, we actually review the documentation, we submit it to the lender for pre-approval. That's how we do it. Now, if you go to a lender directly, they will not go through all the process. They just take it, it's how much do you make, what it is, and then it will actually only be a rate lock. So you may not have all the documentation for it. Okay, you may say, even if you do it online, you say, okay, this is how much I make, this is whatever. You get a pre-approval in Within a minute. The problem is that no one has actually reviewed your documentation to ensure that it will fit the criteria. The problem with that is that when you go look for a house, you thought you got pre-approved for, well, you got pre-approved for a rate guarantee. There's no guarantee that you're going to get pre-approved for that amount that you've qualified for.
And when you are shopping for homes, you want to have that confidence, because knowing that you've gone through the actual mortgage pre-approval, then you have the confidence in shopping the right home.
Exactly, Roshan. I think we've seen so many clients that have gone to look for a house, put an offer in, get the offer accepted. Now, good news is they have the conditional financing.
Yes.
We go through the conditional financing, and then they're sweating for the 5 days because they may not qualify for the mortgage. Sometimes they have to get a co-signer, so there's all sorts of things that's required for that. So it's always better to know upfront how much you qualify for. Then you can go shopping without without making sure that your financing has to be in place on the 5 days that is there.
Wow. So are these pre-approval guaranteed?
The pre-approval guarantees you the fact that you are guaranteed that rate for 120 days.
Right.
We'll guarantee you based on the information you provided. If things change,
Yes.
Something happens, then you have to let us know. And then we will say, okay, based on the changes that you've had, now you actually pre-qualify for this amount of money.
Got it. So once you have pre-qualification done, you have interest locked, and then now you have the confidence to go shop for homes.
For sure.
Got it. What information do you actually require for loan application?
For loan application, believe it or not, we actually ask for the standard document that's required when you actually have a full application and you bought a house, okay? So we're gonna look for income statements. We're gonna look for your T4s. We're gonna look for pay stubs. We may not need the letter of employment right now, but sometimes we do request that, okay? So scenarios is, let's say you're part-time, let's say you're paid hourly wages, we wanna understand that part.
I see.
And then we'll take a look at your bank statements. We wanna see that if you have $100,000 as down payment, we'll take a look at that. That's actually a very tricky part because sometimes there's gifts in there.
Yeah, you go shop for a home, you bought a house, put an offer, now it's conditional on 5 days. What happens next?
Well, this is going to be the easy part for us if we've done the pre-qualification up front. We would have had all your documentation. We may need a little bit of an update. So for example, if we pre-qualified you today, but you don't buy a house 2 months from now, okay? Then we'll say, can you provide an updated information for up to that date?
Got it.
Okay. So we'll get that information because we'll know that you're putting offers in. When we submit the application, we'll submit the documentation at the same time. The lender will have a full file in looking at your application to say, yes, you've been approved, and maybe there may be 1 or 2 small things, and we can say, okay, based on that, you can waive the conditional financing because they're very small.
Got it.
Yeah. The other thing that we also look at is try to get an appraisal on the property. So we actually have to try to schedule an appraisal on the property to make sure that the value of the property is there.
These appraisals, are they your Polo Loans appraisals, lenders appraisals, or anybody you look at on Yellow Pages? Who are these appraisals?
Well, in fact, every lender has a list of approved appraisers. So we cannot select which appraiser to use for your property until we actually agree that this is the lender that you want to choose. From there, the lender will then select their appraisal. It has to be independent, everything's independent. They will then go into the house and make sure that the value is there based on your purchase price.
I see. So I also heard there are different types of appraisals. Some say it's just on the computer, on the system, automatic, some drive-by, and some full appraisals. This all depends on different types of the properties and situation?
Yeah, in general, there's going to be the, what we call the AVMs, which is automatic valuation, where the lender will get a valuation. They'll say, I'm comfortable with this information. But that's generally when you have 25% down payment or more. But when you go to, if you have 20% down, they'll generally have a full appraisal on the property, especially when it's an investment property.
Oh, I see.
If it's an insured deal, which where you have less than 20%, the insurer will do that appraisal when they need to, or they will do the automatic valuation. Very little drive-bys now. Everybody wants to make sure that the house is okay because the outside can be okay, there can be problems in the inside.
Does having a higher down payment give you a better interest rate?
It depends. Okay, that's a tricky question. Okay, so it depends. There are criteria in which you can get a lower interest rate with higher down payment. So I'll tell you what criteria are. So if your house is less than $1 million,
Right.
if you have 35% more down payment, you would actually probably get a very low rate.
I see.
Okay. If you are less than 20% down, we have an insurance rate, which is very low too. Okay. In between the 65 to 80% or 66 to 80%, some of the rates are a little higher. They charge a premium on those rates. Okay. So that's where the interest rate can vary a little bit. Okay. Not much, but they'll vary.
They will publish insured, conventional, and insured seems to be lower rate. Why is that?
Yeah, that's always, I always get that question all the time. That's a good question.
Like, as a consumer, I would say, well, I'm putting 30% down payment for the lenders. I'm giving so much money, it should be less risky.
Yes, and you have to always look at it from the two sides, okay? So as a borrower, you're borrowing money.
Yes.
And then there's also an investor, okay? So when the bank lends money out, they actually have investors, okay? So when you have less than 20% down, you'll know that you realize that you have to pay an insurance premium. This is mortgage insurance. So your rate, if you say you have a lower rate, you actually have to pay an insurance premium, which the good news is that it's added to your mortgage. So it's not a big thing in general because you pay it over 30 years. Okay?
I see.
Now that mortgage itself, think of it as, just singularly, if you borrow $500,000 that was insured, okay, they will go and raise this funds out in the marketplace for $500,000, and because it's insured by the Bank of Canada or an insurer, that value of that bond is much better, stronger.
I see.
And when it's much stronger, they can get a lower rate in lending that $500,000.
The risk is lower because the money is guaranteed also.
The guarantee, the investor is much happier with it, knowing the fact that, okay, if the customer cannot make the payment, it will
Right.
be guaranteed by the Bank of Canada, or it will be guaranteed by the insurer, which is CMHC, Canada Guarantee, or Sagan. Those are the three insurers.
Great. So having down payment, obviously there are situations where you could have a better rate. Now, what about the credit score? Having 850 credit score versus 680, does that play into interest rates, having better interest rate?
Well, there's some lenders where they have specific rates and you have to have specific scores. So in general, by a particular rule of thumb is if you have 720 or greater, you probably have more options where we can actually provide you with lower rates with lenders that will say, okay, I want scores of 720 or more.
I see.
Okay? Now, if you have a score of 720 and you have another score of 880, will it be different? The answer is no. Okay? The example I always use with my clients is the following, right? So let's say, for example, if you were going to get an A, I don't know, when you go to school you get A, B's, and C's. So A
Yes.
is 80 or more, right?
I see.
Okay? A person that gets 81 will get an A. A person that gets 99 will get an A. It's still an A.
Oh, yes. Yes.
It's still an A. That's all it is, right?
I see.
So that's what it is. Now, if you get below 680, then we have to take a look at the risk parameters associated with that, which lenders will do. So as you shrink your options, because the score is low, and that's why it's important to have good credit score. As you have lower scores, your options shrink, and you have less and less lenders available to you.
Yeah, because it could get frustrating because you could have a really solid down payment, you could have a really solid income, but your credit score is not where the lender wants it to be. For a consumer, it may be frustrating. So always watch out for your credit score. Keep it high.
Yeah, I always recommend that people that look at their credit score on a more frequent basis, so
Yes.
they can register to Equifax or TransUnion.
These are free?
Well, actually, the TransUnion and I believe Equifax, it's free for the first one.
I see.
Okay, but if you want to monitor on an ongoing basis, you have to pay a monthly fee for that. Okay,
I see.
and it's not that expensive. So if you want to do that, that's great. But if you have like an 880 score, you may just want to do it for one time. But if you have a score that is, let's say, 650, 660, and you want to monitor to see if it goes up, there's various things that you can do to increase your score. So I would say continue monitoring it and make sure that your score continues to increase over time.
Great. So when somebody is applying for a mortgage, there's this qualifying rate,
Yes.
right? What is that?
Oh, the qualifying rate. This came in probably about 4 or 5 years ago, I think. And it's called the stress test. Well, part of it is a stress test. They call it the stress test rate, okay? So really the stress test is they will qualify you, so we're qualifying you, at a higher mortgage payment based on the interest rate plus 2% or whatever the government sets it at. So today the government sets it at 5.25. Okay, that's their rate that they set up. If you have a rate of, let's say, 4%, I got to add 2% to that, which is 6%. I have to qualify you on 6%. Okay, so that's the qualifying rate. If the rate was, let's say, 2%, and I add 2%, it's 4%. The qualifying rate, because the government set a minimum at 5.25, I have to qualify you at 5.25. So the mortgage payment is based on a higher amount to ensure that if interest rate goes up, you can still qualify to make the payments associated with that.
Okay, so today the 5-year rate is already, let's say, 5.5, let's say.
Yeah.
So does that mean 2% will be added to it and you have to qualify at 7.5%?
Unfortunately, yes, you have to qualify 7.5.
Wow. So Ming, this is an important question. I'm sure you've heard it many times. What type of interest rate is best for me?
What type of, yes, everybody always asks that question. It will all depend. It will all depend on your situation, okay? So part of it depends on the market. So let me give you a quick example, okay? Today, in the market today, it doesn't make sense for people to go for a variable rate mortgage because the variable rate mortgage is very high. Now, there are cases where it may make sense. So we have to take a look at sitting down with you and seeing what's important to you, what we need to do to make sure that, first of all, you qualify.
Yes.
Okay? That's important.
Yes.
And then after that, once you qualify, what are some of the options available? So, and even when customers come to me and say, you know, Ming, I want the lowest rate. I said, everybody wants the lowest rate.
Yes.
Why would you want to pay the highest rate?
Yes.
It doesn't make sense. We will, but the important question to you is what aligns to what you need.
What are your goals?
What are your goals and things like that, okay? If you're looking at selling the property in 2 or 3 years, then maybe the variable rate maybe make the most sense because the penalty calculation associated with that is very small. You may pay a higher premium on that, right? And sometimes the lowest rate is not necessarily the best rate for you.
Okay, why is that?
Oh, because there's a lot of things, restrictions associated with that. For example, some of the restrictions is that you can't sell your house unless it's on the MLS. You cannot refinance your house unless it shows up on the MLS and it has to be sold.
That's a contractual terms on a lender's mortgage.
For sure.
Wow.
And sometimes the penalty may be higher if you break it.
Wow.
So those are the options they have. So maybe you may save a little bit, but then you'll find that, you know, when you take a look at breaking the mortgage, I didn't know this. It becomes a problem. You can't break the mortgage. So we generally don't go for the lowest rate because there's a lot of restrictions, and when we go through the restrictions, they'll say, oh, I'm actually surprised. Sometimes the customers don't know because the first thing they look at is, give me the lowest rate, and they say, oh, this is the lowest rate, that's what I want.
Wow, so lowest rate is not automatic.
Exactly.
Wow. So after you speak with your clients, then you also recommend, based upon their profile, the right loan for them,
yes.
right? And are there a lot of features in loan that could dictate it?
Yes, well, there's a couple of key features that we talk about, right? So number one is the prepayment privilege. How much can you pay on a yearly basis, okay? In general, we're seeing about 15%. Okay. Now, you know.
I wish I had that prepayment money sitting around.
Yeah. Well, I always tell them, I said, is 15% enough for you? They said, no, maybe a little bit more. I said,
I see.
If you pay 15% a year for the next 5 years.
So that's a 15% of outstanding balance of the mortgage.
15% of the mortgage amount.
The original mortgage amount, not the balance.
Not the balance.
Oh, wow.
15% generally is more than enough. The second one that I talked to you about is the penalty associated if you break a mortgage, okay? So if you break a mortgage and you have the lowest rate, the breaking of the mortgage, the penalty associated with that can be a little higher. You know, it could be much higher actually, some of them. So, and the third thing is if you break the mortgage, some cases you can't do it unless you actually sell the house on MLS through a realtor.
Wow, that I didn't know.
Yeah, and the thing with that is that it actually stays with you until the term, as long as you stay with it. So you renewed 5 years from now,
yes,
that criteria still stays with you the next 5 years. So the first 5 years you say, oh, I don't think I'm going to sell your house. Okay, that's good. But in 5 years from now, you may look at selling your house. Then it becomes a problem.
Okay, so now, aren't there a solution around this, what's called porting your mortgage?
Oh yes, this porting on a mortgage is where you actually move your mortgage from one property to another property.
Yeah, so if a lender has those restrictions that you sell it on MLS and you do it in accordance to them, and you bought, let's say you're upsizing, now your mortgage was 300,000, now you need 500,000, could you not take the remaining to the new mortgage?
Yes, most of the lenders allow you to port, and obviously when you port it, you're in most cases people are upsizing, right? So they'll probably need a little bit mortgage. So they may blend the rate. The situation that I'm talking about actually is some people that are looking at refinancing.
I see.
So if I'm refinancing to get more money out of my home because I've paid it for a period of time, they're going to say, no, you can't break it because you're not selling your house.
I see.
That's where the biggest problem is.
So the home buyers put a mortgage financing condition.
We always recommend the conditional financing, okay? There's one thing that we don't really control is the appraised value of the property.
Got it.
Okay, so we can say you've been approved for this based on this amount, but we don't know what the appraised value is on that, right? So if an appraiser goes in there and takes a look at it and says, okay, yes, it's appraised at this value, your mortgage is approved. So for example, you were approved for 500,000, you bought a house for 600, you put a purchase of 600,000, so you have $100,000 down payment. If the appraised value came in at 550, you have a gap of 50,000. Where are you going to get the other 50,000, right? If you say, I do have the extra money, that's not, okay, so generally once the purchase is done, when we have all the documentation, we can probably get it within 48 hours, everything.
Got it.
And then if we get the appraisal right away, we can get it within the next 36 hours, or it can be no more than 4 days we can get an appraisal done on that property.
Great. As a real estate professional, we always put the 5 business days as a condition, and that 5 business days seems to be reasonable then.
It generally is reasonable. Now, it's still pretty tight, but it works for us.
And especially it helps if you've done the pre-approval and you've looked at the file prior to it.
Yes. There's a couple of reasons for that, right? So number one is take the stress out. Okay? If you come to us on the last minute and say, I bought the house, now I want to get my approval on this deal, we're going to be asking you for all this documentation, and you're going to have to be pulling it all together in the next 24 hours. Now,
employment letters.
Yeah.
Going to the employer to get through their HR. If it's a bigger company, there could be a turnaround time there.
Oh, those, sometimes that could take a little bit longer for sure, if you're not prepared for that. And then you have to get your bank statements. Now you get your bank statements, I have the 3 different accounts. Now you have to start pulling them from all the accounts. So it's going to be a lot of work for you to do it on the day you purchase the house versus, let's say you're buying a house in Roshan, you're going to be meeting with them, you're going to be talking to them, you're going to see what you need and all that stuff. And at that time we get the information from them. We'll have a little bit more time for you to pull the information. We'll say this information is okay, this information is not okay. And I believe me, the lenders are very, very picky. Yes. You can't just go take, for example, bank statements. I see a lot. Bank statements, you show me 90-day history, everybody goes online, prints it out. I have the account number, but I don't have the name. So now I'm going to go back to you and say, oh, this is not acceptable. I need you to have a bank statement that has your name. So if we can be going back and forth a couple of times to make sure that the information is accurate and acceptable to the bank lenders.
Got it. So once the mortgage is approved by the lender, and let's say your closing is in 60 days, are there any particular, like a closing remarks or closing advice you give to your buyers?
Yes, we always provide one of the advice on making sure that they don't go out there and start shopping. So you're not free to buy things until you actually close your house.
Why is that?
Well, because the lender has the ability or they have the right to pull a credit bureau any time prior to closing. If they see that you have additional debt in there,
new appliances, new furnitures, and all kinds of retail balances I have can now work against because it's a loan. It has to be paid back.
For sure. And the one thing that I always advise the customer in our pre-qualification is do not go out and get a car, loan for a car or a lease. Because if you do that, that liability becomes part of the qualification, so we have to add it in, okay? It is very easy to get a loan approved or lease at any time. it is very hard to get a mortgage approval. So just get your mortgage approved first, and thereafter you can go for your lease or your loan for a car. Well, if you have a longer closing date, so generally when you have a 120-day rate guarantee with regards to the purchase, generally they will not be doing an appraisal. Now, have that been done before? And some of them have done that, which are smaller banks, because they know that the market has come down and there's some risk associated with that. So they may be doing that. But in general, they won't do that. Now, if your closing period is beyond the 120 days, they will always pull a credit bureau 30 days prior to closing.
I see.
They may even go do it closer if they find that there's discrepancy. They will be calling your employer. They can call right up to the day of closing, the day before, and they can say, hey, you're no longer employed. They can cancel the deal on you. So make sure that employment is a very important thing.
And what happens if I switch the job?
Well, I always say the following to them, right? So if you are in a position where you're switching jobs where you're going to get more money, promotion, we have to weigh the benefits associated. I would say, come to me, talk to me first. I will then speak to the lender, and I will use generic words to them. They won't know this is application. I will say, okay. Or worst cases, I will find an alternative lender that will say they will accept that. Because if someone's going for promotion, they're making $100,000, they're moving to $125,000. It makes sense. It's logical, right? Yes. Why wouldn't you want to move over? So in most cases, in those scenarios, the lender may accept it.
What happens if there is a probation?
A probation? Well, usually when you've been working in the industry for a long time, they will understand that, and probations are generally set with all jobs, but they will accept that because you've been in the profession for a long time.
So you will transition well.
Transition. Now, on the other hand, it's case by case though.
I see.
Okay? So in general, they will allow that. Okay? But there are situations where you move from one industry to a different industry, different occupation, where there's a probational period. They will not accept that.
Terms. Right. What is an insured mortgage and what's a conventional mortgage?
Yes, on the insured mortgage, it is anything that you have less than 20% down. It is guaranteed by the insurer. So if you miss payments, if you do whatever, they guarantee the bank that the payment is made. In fact, prior to the insurance, the banks cannot lend money out to anybody that's buying a home with less than 20% until the insurer came out.
I see.
So that came out, the government put this program together because they want more people to own homes.
Absolutely.
Okay? So that's the insured side, okay? Anything that's less than 20%. Now there's also the conventional side, or I guess you call it the conventional. It's conventional mortgages. On the conventional side, anything that is 20% or more.
I see. Okay. What's the minimum down payment that's required?
The minimum down payment that's required is 5% down on mortgages on properties up to $500,000. Anything that is between $500 to $999, it is 10%. So if you go $500 to $600,000, you have the $25,000 down for the first $500,000, $10,000 for the next $100,000. Oh,
I see. It's on a tier system.
Tier system.
It's not like 10%. For the entire $1 million, if it's under $1 million, it's actually first 500,000, 5%. The next remainder of that $500,001 to $999 is a 10%.
Exactly. And then when you hit the 1 million mark, it's 20%. Yes. Okay. So on a fixer-upper, it can be very small in nature. It can be like just do a small renovation, 50,000. Maybe even up to 100,000 depending on the house. There's what we call purchase plus improvements.
Okay.
Yeah. So people can actually buy a house and say, okay, I'm looking at some improvement in the house. So usually it's fairly quick. It's within 90 days, no more than 120 days after closing. So you can be changing the window. You can be doing the shingles on the roof. You can be doing some work on the furnaces and things like that. So what the lender will say, yes, I will approve you instead of $500,000, I'm going to approve you for $550,000 on this mortgage because we know that you're going to do the improvement. Once the improvement is complete, they will have an inspector come in and say, okay, by the way, that's good for you. We can add that extra $50,000 to your mortgage. You can have those funds to pay all the trades that come in to fix it. So that's one. The second one, which are fixer-uppers, where you're buying a house and the inside is really not livable.
Right.
Okay. Right. And this is where you're tearing everything down. there's not going to be a lot of lenders that will lend you money for that.
I see.
Yeah, so if you're just doing, let's say, a kitchen renovation, that's workable.
Oh, that's workable.
Yeah, like it's 50, 80,000, 100,000, depending what it is. But if you're doing like a tear down everything, like you're gonna make everything tear down, you're gonna
I see.
redo
Bigger
the
scope.
rooms. Yeah, it's the scope of it, right? So really, you're moving in. So think of it this way: the easy way to look at this is the following: if I'm moving in, can I live there while that renovation is happening? Okay. If I'm going to tear it down, I'm probably not going to be able to live there. And the lender's not going to let. Now, it doesn't mean that we can't get you financing for it. It means that in the short term, we can get you what we call private lenders. There are private lenders that are out there to do that. So they'll lend you the money to do all the refinancing. At the end of the completion, we'll go to a lender, we'll appraise it. Now it's going to be higher because you've done all this renovation. And you may be able to get a little bit more.
I see.
But the minimum at that time, you have to have 20% down.
What are the, some common reasons why mortgages do not close?
Oh, common reasons why. Okay, so we talked briefly about a couple things, right? So number one is someone took an additional debt between the closing time.
Yes.
Right? Number two is job changes.
Yes.
Right?
Industry changes particularly.
Yeah. So something happens there. I've worked with a client where the closing was a little longer, and one of the co-signers decided that she can't work in that job for good reasons.
Oh, even co-signers.
Yeah, even co-signers.
Wow, it's not the primary borrowers, they still have the same job, but the co-signers switching job could impact too.
Could impact, yeah,
wow.
For everybody, yeah. So even that situation where it becomes, they won't close the deal because of that, because they, like I said, they still have the right to call the employer or whoever it is 30 days, 1 week, a few days prior to closing if they suspect something.
Right.
So that could be the case. An appraisal, the appraised value of it, right? So if the appraised value doesn't come in as what they stated, then that could be a problem in terms of closing.
When I'm working with a lot of home buyers and sellers, there are a lot that are also looking to move up. And if they are, mortgage year 3, what are their options?
Yes, so if someone's looking at moving up in year 3, they can port their mortgage from their current lender to another property. That's option 1. That generally is the cheapest for them because they don't have to pay a penalty.
Okay.
Right? So they can port the mortgage. Now, whatever they need in addition to that, sometimes the lender blends it all together in as one. Okay. Now, there are situations where if you have a variable rate mortgage and the penalty is only 3-month interest, this is a situation where it makes sense for them just to pay the penalty, redo the mortgage at a lower rate.
Got it.
Okay, so we do definitely have that option that's available. Prior to the increases in the rates, a lot of people had variable mortgage and we're able to convert them. And it made sense. We sit down and say, okay, here's how much you have to pay in penalty. Here's the new mortgage that you're doing. You're going to get a more favorable versus porting it over.
I see.
Because now they blend the rates and all that stuff. So it doesn't make sense for them. Okay, so that's really one of the options that's available to them.
Now let's talk about first-time home buyers. What are some of the first-time home buyers incentives or some help that they have on purchasing their first home?
So if you're talking about first-time home buyer, we're talking about assistance from the government. There's programs for that. We're talking about the lender. There's things for that. So let's start with the government. The government has a program whereby they have an equity ownership of the house. It's called the first-time home buyer.
Government will have equity ownership.
That's right. So as long as you meet certain risk criteria, now it hasn't been very popular because the home prices in the GTA are very expensive.
I see.
So they have very restrictive guidelines. So let's say, for example, if you're buying a house for $500,000, you put 5% down, so which is $25,000. The government can put 5% down on top of that, so now you have 10% down. But if the house goes from $500,000 to $1 million, then the government owns 5% of the house. So if you sell it, you have to sell it. So that's an incentive program that's available to them.
Okay? Right.
Now, I'm not going to talk about the down payment part because there are different incentive programs for that, right?
I have some questions around down payment.
Okay, so we'll just start with that one.
Yeah.
Okay? So now, on the lender side, they do have cashbacks that's available to you. So they know that you have closing costs, you have to pay that. So you may want some cashbacks associated with buying furnitures and things like that.
I see.
So they have that available. Now, the cashback is not free.
Oh, yes.
You're paying it through a higher rate. So if they give you a
I see.
3% cash back, you're paying it through a higher rate.
I
So
see.
that's available. So it is a balancing act. Now, the other thing also to be important about is that if you break the mortgage, let's say for example you took a $5,000 cash back.
Yes.
If you broke the mortgage after year 3, then you have to give them a prorated portion back, which is $2,000 you have to give them back.
Oh.
Yeah, of that 5,000.
So it's, you just don't go
not-
out spending thinking is you don't have to repay back.
That's right.
I see. First-time home buyers, you know, oftentimes are struggling to save money in this environment. Everything is expensive. What are some of the down payment options if they are short of the down payments?
Yeah, so on the down payment options is obviously the savings. They're always going to be looking at the savings, which is a 9-day history of that. But we have a lot of clients whereby they get gifts from parents. So it's the bank of mom and dad, they call it. So that's one of the options available to them.
Gifts are allowed?
Definitely, gifts are allowed.
Is there a maximum threshold?
There's no maximum threshold for that. Now, if the amount is high, they may ask for the gifter to provide a bank statement and say that that money is available. So we have to make sure that that's there, okay? So parents are allowed to give as much gifts as they want to their parents. They could consider it as an early inheritance if they want to, right? So that's an option to them. The other ones, you know, it is allowed, but we have to review the criteria based on lenders. That means that they can have a short-term loan for part of the down payment. They could do that. Okay, so if your criteria, let's say for example you have 5% down and you want to put a little bit more, you can borrow some money from your lender, but it's going to be part of the ratio. So we have to take a look at the payments, and we have to say that we're using part of the loan for the down payment.
I see. And so can siblings give them money as a down payment?
Yes, siblings can give, as long as they're family members, they can give.
Oh, wow.
So,
So my neighbor cannot give?
Well, if your neighbors can give, I like to know your neighbor. I like to know your neighbor. Okay?
I see.
Yeah.
So it has to be your sort of immediate family who is lending you, and it has to be a gift, not a loan.
Yes, it has to be a gift and not a loan. If it's a loan, then you have to add it as part of your liability. So it's
Got
a gift.
it.
Now, when we say immediate family, we really mean parents, siblings. When you get into like aunts and uncles, there's going to be a lot of questions about that.
It happens.
Yeah, so generally there are, the approval of the process that we do is no different than what we do within a full application. We go through the whole thing, we get it approved, we send it to the lender, and we say, okay, based on your information and the situation that is today, you would actually be approved for the mortgage. There's very little guarantee. Some of the lenders will go up to a year.
I see.
Okay, but they won't go 3 years or 4 years because the lender, things change in 3 years. You could have a new job, right? You could have additional debt. So 30, 60 days prior to that, a full application will be
Got
done
it.
again. And they will review your application as though it was day one 3 years ago. If you still qualify at that time, then definitely you will be qualified for the mortgage. If things change, for whatever reason, they have the right to decline the deal. So the assumption here is that you're exactly the same way you are 5 years. Now, the other thing also to note is that interest rate could go up substantially too, and you may not qualify based on that. When they do the appraisal, it's always going to be the appraised value based on the market condition at that time,
At that time, not the purchase price.
not the purchase price.
Wow.
Yeah. So the criteria in which they will approve the deal is the lower of the purchase price or the appraised value.
If somebody's looking to get their second property, what does their mortgage qualification look like?
Yeah, and that's, you know, with regards to working with investors, it is a little bit more complicated. And what I mean by complicated is that a lot of the investors, they would take equity out of their house
Yes.
today, and they will use that as part of the down payment on a new house.
Yes.
Okay, so I will work with them on their current house, and I will say, okay, how much, you know, a lot of times their house prices have gone up a lot. They say, let's take equity out of this house and help me with the down payment on the next house. So I would do all the financing, I would do all the calculation for them. I would do 2 mortgages for them, one to do the refinance and then one to do the purchase of the home.
Yes.
Okay? Or we have clients where they do have their current down payment. So let's say, for example, the ones that you're talking about where it's a pre-construction, they already put a lot of the down payment down for the house because the minimum they need is probably 20%. Then I would just qualify them based on the qualification of the house.
So Ming, I have some rapid fire questions, something like myth or truth. Let's go. All right. You can get an interest-only mortgage in Canada.
Well, it's, I would say that yes.
Yes,
Okay?
you could.
You could, okay? And it all depends on how you look at the mortgage. So for example, if in situations where you have a secure line of credit on your property, okay? You get approved for it, you can say, but it's maximum 65%, but the secure line of credit will allow you to pay interest only.
Oh, I see.
Right? So it is true. Like it sounds like it's, and then there are cases where you actually go to private lenders, well, they will allow interest only. But on the bank side, you can have a secure line of credit where it's interest only.
I see, I see. You can get 100% finance?
That's a myth.
That's a myth.
You need some down payment. They're looking for skin in the game.
I see.
Now, if anybody ever provides you with 100% financing, I would say run. Okay? Because, you know, you think of it, the interest rate is going to be high, they're going to be charging a fee. I don't think you're ever going to get out of there.
Yeah. So credit score of 800, 6, and 600 are the same.
Yeah, 800 and 600 is not the same because, you know, the cutoff generally is about 680. You know, 700, 720 above is all the same. You know, when you get below 680, then it varies. It varies for sure.
I see. You can assume a mortgage?
Yes, you can definitely assume a mortgage. Now, it's not popular anymore to assume a mortgage, okay? Because really, when the person that is assuming the mortgage still has some liability on the mortgage.
So myth or truth, strangers can give me money for down payment.
Well, strangers can give me money to spend. I'd be happy about that, but definitely not the down payment.
The lenders won't take that.
No,
huh?
I won't accept that, yeah.
I see.
mean, you may have very good friends.
Yes.
You may have very good strangers, and you can go have a nice dinner, and that's about it.
That's it. That's it. Okay. Well, thank you, Ming, for your time. Where can people find you?
Yeah, so first of all, Roshan, thank you for inviting me to this session here. It was very, hopefully people will learn a little bit more about the mortgage financing and things
Absolutely.
like that. But then they can get it told me through my cell phone. I have
Yes.
a phone number.
And I have it right behind the screen as well.
Yes.
Your phone number, your email, and the Polo Loan Company information.
Yeah, and it's very simple. You know, a call to me, you know, it only takes about 15 minutes for the pre-qualification. Once the pre-qualification and you're okay with that, we say, okay, do you want to move to the next step and get the online application? And then we move forward from there and formalize the whole process for you.